$600,000 a year. And she asked me to borrow rent money. That sentence should not exist. But it does. And it exists more often than anyone earning six figures wants to admit. Her name doesn't matter. Her job title does. Senior partner. 14 years in. A house with a wine cellar. A car that leases for more than most people's mortgage. And a checking account that, on the 28th of every month, sits dangerously close to zero. This is not a story about bad luck. This is not a story about one reckless spender. This is a pattern. A repeating, predictable, mathematically consistent pattern that shows up in surgeons, in software engineers, in agency owners, in anyone who crossed the income threshold everyone else is chasing and found something waiting on the other side that nobody warned them about. You think more income fixes money problems. It doesn't. It hides them. That's loop 1. Here's loop 2. There is a specific number, a specific monthly income range, where people become statistically more likely to carry debt they can't explain, not less. Not because they earn less, because of what happens the moment they earn more. And loop 3, there is a test, a real one, that takes 11 seconds to run on your own life. And it will tell you with brutal accuracy whether you are actually financially secure, or whether you are performing financial security for an audience that isn't even paying attention to you. She isn't alone, either. A surgeon making $800,000 a year, 3 years into practice, quietly asked a colleague for a short-term loan to cover a property tax bill he'd forgotten was due. A creative director earning $240,000 sold a watch he'd bought to celebrate a promotion, just to make a car payment before the 5th of the month. None of these people are careless. All of them would be insulted by the word broke. That gap between the number that describes them and the reality that governs their actual days is the entire subject of this video. We're going to run that test before this ends. But first, you need to understand the trap. Because it isn't stupidity, it isn't laziness, it's design. And once you see the design, you can't unsee it. Wrong assumption. The obvious explanation for high earners with no savings is overspending, lifestyle, vanity, weakness. That's the story people tell so they can feel superior to it, from a safe distance, without ever checking whether the same architecture is quietly forming underneath their own life. It's incomplete. And incomplete stories are dangerous because they let you believe you're immune. Here's what actually happens. Income rises in a jump. A promotion, a new job offer, a business finally breaking through. And the jump feels like proof that the hard years are over, proof that the person has arrived somewhere solid. The brain treats that number as permanent the moment it appears on a screen, not as a possibility, not as a range, as a floor. A new, stable floor that will obviously never fall. That single assumption is the first crack, because a floor invites weight, and weight in financial terms has a very specific name. Fixed costs. A mortgage size to the new income. A car lease signed off the new number, not the old one. A private school deposit. A membership. A second property that makes sense now. None of these purchases happen recklessly. Each one, on its own, looks completely rational in the moment it's made. That's what makes this dangerous. It doesn't feel like danger. It feels like earned upgrade. Read that again. It feels like earned upgrade. That single phrase is doing more damage, quietly, than almost any other sentence a rising income ever produces. Nobody sits down and thinks, I am about to build a structure that will consume my flexibility for the next decade. They think, I finally get to live the way I've been working toward. And for a while, it works. The house feels good. The car feels good. The tuition feels like investment in someone they love. Every individual decision, evaluated alone, defends itself. The problem was never any single decision. The problem is what happens when 4 or 5 of those decisions stack on top of each other at the same time against an income that people quietly assume will never go down, never get taxed harder, never get interrupted by a bad quarter, a lawsuit, a market correction, a layoff nobody saw coming. That's the setup. Now here comes the part that changes how you read everything before it. The zero income test. Ask yourself one question. If your income stopped completely tomorrow, not reduced, stopped how many days before your fixed costs break you? Not your feelings, not your identity, your fixed costs. Mortgage, lease, tuition, insurance, minimum debt payments. The obligations that don't care why the money stopped. For most people earning modest, stable incomes, the honest answer is uncomfortable. Maybe 60 days. Maybe 90 if they're disciplined. For people earning enormous incomes, the number is sometimes worse. Sometimes far worse. Because the fixed costs scaled up exactly as fast as the income did, and in some cases faster. Financed by the assumption that tomorrow's paycheck was as certain as gravity. That's the mechanism. That's the whole trap in one sentence. Income went up. Certainty did not. But spending behaved as if it did. This is why a person can look, from the outside, completely secure the house, the car, the vacations posted online, while privately living closer to the edge than someone earning a third of what they earn. Rich on paper, broke in reality. Say that back to yourself. It's the whole video in 5 words, and it's worth pausing on, because most people scroll past sentences exactly this simple without letting them land. Now let's go deeper, because the story gets worse before it gets useful. Block 2. The part that gets specific. Picture 2 people. Same city, same age. Person A earns $90,000 a year. Person B earns $310,000. Person A rents a modest apartment, drives a used car with no payment, and keeps roughly $11,000 in savings. Not because Person A is a genius, because Person A never had access to bigger obligations, so none were ever built. Person B owns a house with a jumbo mortgage, leases 2 vehicles, pays private tuition for 2 children, funds a country club membership that matters for networking, and carries a home equity line of credit that quietly covers the gaps most months. Ask which one could survive a 6-month income disruption without selling something or borrowing from family. The honest answer, disturbingly often, is Person A. Run the same comparison through a few other professions, and the pattern repeats with almost boring consistency. Take a corporate attorney, mid-30s, salary just crossed $400,000 after a partnership track promotion. Within 18 months of that promotion, her monthly fixed costs had grown to match nearly the exact ratio of her old salary to her new one. Bigger mortgage, upgraded car, a renovation financed through a home equity line rather than cash, because the equity was just sitting there anyway. 18 months in, her liquid savings were lower, in absolute dollars, than they had been the year before the promotion. Take a business owner whose agency finally crossed 7 figures in annual revenue after 4 lean years of reinvestment and stress. The first year of real profit went almost entirely toward what he described, honestly, as finally not feeling broke anymore, a home purchase in a nicer school district, 2 vehicles, a membership he'd wanted since business school. The agency's revenue was real. His personal liquidity, 12 months later, was thinner than during the lean years, because the lean years had forced discipline that the profitable year quietly dissolved. One more, because this one surprises people the most. A commercial real estate agent had a career year $900,000 in commissions, more than triple her previous best year. She bought a second property as an investment, upgraded her primary residence, and financed a boat she'd wanted since she started in the business. The following year, commercial deals in her market slowed by nearly 60%, an ordinary cyclical downturn that anyone in that industry should expect eventually. Her income for the year came in under $200,000, still a good income by most standards, but a fraction of what her fixed obligations had been built around. She spent that entire year selling the boat, refinancing the second property at a loss, and quietly wondering how a $900,000 year had left her more financially fragile than the years before it. None of these people are outliers. They are the median case. Once you start actually asking the question, instead of assuming the number on the paycheck answers it for you. The industries differ. The titles differ. The specific asset sold in a bad month differs. The underlying mechanism is identical down to the decision points. There's a tax dimension to this pattern that almost never gets discussed, and it makes the whole trap slightly worse than it already sounds. Which means the actual take-home increase from a raise is always smaller than the headline number suggests. Someone whose salary jumps from $200,000 to $300,000 does not see an extra $100,000 land in their account. After federal tax, state tax where applicable, and payroll tax, the real increase in spendable income is often closer to $60,000 or $65,000. But the mortgage broker, the car dealer, and the private school admissions office often price their offers against the headline number, not the after-tax reality. The gap between the number that gets celebrated and the number that actually arrives in the bank account is where a meaningful share of this entire trap quietly gets built. Not because $90,000 is more money than $310,000. Obviously it isn't. Because person A's obligations were sized to reality, and person B's obligations were sized to a story about the future that hadn't happened yet. This is the part high earners resist hearing the most, because it sounds like an insult to their intelligence. It isn't. Every person in this pattern is smart. Most are exceptionally competent in their field. That's precisely why the trap works. Competent people trust their own judgment, and their judgment tells them, correctly, that each individual purchase makes sense. Competence at earning money is a completely different skill than competence at protecting it. Nobody teaches the second one. Universities don't. Employers don't. Nobody sits a newly promoted executive down and says, "Congratulations. Now here is how obligation math compounds against you." So the skill gap gets filled by something else. Marketing, peer comparison, lifestyle signaling, all the forces that profit directly from a rising income being converted immediately into rising commitment. That's not a conspiracy. It's an economy. An entire industry of homes, cars, schools, and experiences priced specifically for people who just crossed an income threshold and are primed to prove it to themselves. They're not selling you an object. They're selling you evidence. Evidence that the version of yourself who struggled is finally gone. And evidence is addictive because the moment it stops arriving, doubt creeps back in. That's the psychological engine underneath every purchase in this pattern. Not greed. Reassurance, a constant, low-grade need to confirm that the climb was worth it, purchased one fixed monthly obligation at a time. Now it gets personally relevant whether the income in question is $300,000 or $980. Because the same mechanism runs at every level. Someone earning $60,000 who upgrades every single time a raise arrives is running the identical program as someone earning $600,000. The dollar amounts differ. The trap is the same trap. The test isn't how much you earn. The test is the gap between what your income could theoretically absorb and what your fixed obligations actually demand every single month, whether you feel like paying them or not. That gap is where freedom lives, or where it quietly disappears. Block 3. This is where it gets emotionally sharper. There's a specific moment inside this pattern that almost nobody talks about publicly, because admitting it feels like admitting failure in a life that looks, from every visible angle, like success. It's the moment someone opens a banking app, sees a healthy 6-figure salary hit the account, and still feels a small, cold spike of anxiety about whether this month's obligations will clear before the next deposit lands. That feeling doesn't match the income. That's what makes it so disorienting. The number on the paycheck says stability. The feeling in the chest says something else entirely. And most people don't tell anyone about that contradiction, because who would believe them? Who wants to hear that the person with the beautiful kitchen is quietly stressed about the HELOC payment funding half of it? So the feeling gets hidden, buried under another purchase, usually something that reasserts the story. A dinner, a trip, an upgrade, anything that turns the anxiety back into evidence that everything is actually fine. This is the loop that traps people the longest, because spending to soothe the anxiety about spending is one of the most efficient debt engines ever accidentally invented by ordinary human psychology. It doesn't announce itself as a loop. It just quietly repeats, month after month, disguised as a series of unrelated decisions. Here's what that loop looks like in an actual week, not an abstraction. Monday, the mortgage payment clears, and the checking account balance drops lower than expected because a quarterly insurance premium hit at the same time. A small flicker of dread. Nothing dramatic, just a flicker. By Wednesday, that flicker has quietly reshaped the mood of the whole week. There's an irritability that doesn't attach to anything specific. A tightness that shows up in conversations that have nothing to do with money. By Friday, there's a dinner reservation at a restaurant that costs more than it should, booked almost automatically as a kind of correction. Not celebration. Correction, a way of telling the nervous system, we are fine, look, we can still do this. The dinner does its job for about 3 hours. Then, Monday arrives again, and the mortgage payment clears again, and the balance is a little lower than it would have been without Friday's dinner, and the cycle resets with slightly less margin than the week before. Nobody chooses this consciously. That's what makes it so effective and so exhausting. It isn't a character flaw, it's a nervous system responding, rationally, to an unstable signal by manufacturing artificial stability wherever it can find it, one purchase at a time. That's where people get trapped. Not in one bad decision. In a loop that rewards the exact behavior that caused the discomfort in the first place. And there's a second layer to the emotional sharpness here, one that hits even harder once you notice it. Identity, somewhere in the climb, income stopped being just income. It became proof. Proof to a parent who doubted the career choice. Proof to a sibling who used to earn more. Proof to a younger version of the same person who grew up watching bills go unpaid and swore, silently, that this would never be their life. That kind of proof isn't optional to maintain. It's psychologically load-bearing. Threaten the lifestyle that represents the proof, and you're not just threatening a budget line. You're threatening the story someone tells themselves about who they became. That's why so many high earners will cut almost anything before they'll downgrade the house, the car, or the school. Those aren't line items to them. Those are identity anchors. And identity anchors get defended long after the math stops supporting them. Read that twice. because it explains almost every irrational financial decision made by otherwise brilliant people. They are not choosing the expense. They are protecting the story. This is why financial advice that only addresses spreadsheets tends to fail this specific group of people. You can hand someone a perfectly sound budget, show them exactly where the leak is, and watch them nod, agree completely, and then change nothing because the spreadsheet never touched the actual thing being defended. Nobody defends a car payment. People defend the version of themselves the car payment represents. Address the number without addressing the story underneath it, and the number simply finds a new home a few months later in a slightly different form, while the underlying defense stays fully intact. This is also why the people who do eventually change tend to describe the moment the same way, almost word for word, regardless of their industry or income level. They don't describe a realization about math. They describe a moment where protecting the story stopped feeling worth what it was costing, a moment where the anxiety of maintaining the appearance finally outweighed whatever comfort the appearance used to provide. Now, before the next layer, a short pause on something that sounds small. It isn't the subscription, the membership, the small monthly fee that never gets reviewed because it's only a few $100s. Multiply that by 6 or 7 similar small fees, layered in over years, none canceled because none feel significant in isolation. That number looks harmless. It isn't. Stacked fixed costs are the quiet architecture of this entire trap, and almost none of them were approved with the whole structure in mind. Each was approved alone, against the income of the moment, with no accounting for what else was already stacked beneath it. Block 4. Here's where the picture becomes system level, and this is the part that should genuinely unsettle you. This pattern isn't accidental, it's incentivized, from multiple directions, by systems that profit specifically from high earners converting income into obligation as fast as possible. Lenders profit. A person with a large stable income and no savings is, from a bank's perspective, an excellent borrower, reliable cash flow, low default risk, easy to approve for a jumbo mortgage or a large auto lease. The bank doesn't care whether that person has 3 months of runway. The bank cares whether the payment clears. Employers benefit, quietly, in a different way. An employee whose lifestyle depends on the current paycheck is a more compliant employee, harder to walk away, more tolerant of unreasonable hours, unpaid overtime, toxic management, because the fixed obligations don't allow for a gap in income while searching for something better. There's a version of this that hits business owners and commission-based earners even harder than salaried employees, because their income was never actually stable to begin with. It just occasionally looks stable in hindsight. Consultant who sizes their mortgage against the $600,000 year spends every lean year in quiet crisis, wondering why a $400,000 income feels so precarious. Consider what a jumbo mortgage actually looks like once it's underwritten to the top of someone's income rather than to a comfortable margin below it. A household earning $350,000 a year, approved for a mortgage that consumes 40% of gross monthly income, has functionally handed a large share of its financial flexibility to a lender for the next 25 to 30 years. The bank took on almost no risk in that transaction. The household took on nearly all of it and experienced the approval as a reward rather than what it structurally was, a transfer of leverage. That's an uncomfortable sentence. Say it slower. There's a version of this story that plays out inside a career, not just inside a bank statement, and it deserves its own moment because it's rarely framed this way. A marketing executive stayed in a job for 6 years past the point where she knew, privately, that it was damaging her. long hours that bled into weekends, a manager whose behavior would have gotten her to walk away at any earlier stage of her career. She stayed, and she knew exactly why she stayed. Even if she rarely said it out loud, the mortgage on the house her salary had qualified for, the tuition deposit already paid for the fall semester, the car lease with 2 years left on it. Leaving meant a gap in income that her fixed obligations weren't built to survive, even for a month. That's not a coincidence, and it's not unique to her. A person whose lifestyle depends entirely on their current paycheck has, functionally, handed a significant amount of their negotiating power to whoever is paying that paycheck. They can't easily walk away from a bad manager, a bad culture, a bad opportunity that requires an income gap to pursue. The freedom that a high income was supposed to represent gets quietly converted into its opposite, a specific, well-compensated form of being stuck. The financial industry has its own version of this incentive, one worth naming directly. A meaningful share of financial products marketed toward high earners are structured in ways that benefit the institution selling them more than the person buying them. A cash value life insurance policy, pitched as a wealth-building tool, sold with commissions that reward the advisor heavily in the first few years, regardless of how the policy performs afterward. A home equity line of credit marketed as unlocking the value that's just sitting there, which sounds like access to money that was already yours, but functions as new debt secured against the one asset most families can least afford to lose. None of these products are illegal. Most of them are disclosed, technically, somewhere in paperwork nobody reads closely. But the incentive structure behind them consistently rewards conversion of stable, boring net worth into leveraged, fee-generating complexity, and the person on the other side of that conversation is rarely told, plainly, which side of the incentive they're standing on. None of this requires believing that bankers, employers, or advisors are acting in bad faith as individuals. It only requires noticing that an entire ecosystem of separately reasonable incentives points in the same direction, consistently, and that direction is rarely toward more flexibility for the person earning the income. The trap doesn't just cost money, it costs leverage. The exact leverage a high earner should have the ability to walk away from a bad job, a bad client. A bad situation gets quietly dismantled by the very obligations that were supposed to prove they'd made it. And the social economy profits too. Every platform, every feed, every curated post of the car, the trip, the renovation, runs on comparison. Comparison sells. It sells houses, sells vehicles, sells vacations, sells private school tours. An entire advertising ecosystem is built around convincing someone who just got a raise that the raise means nothing until it's converted into something visible. Nobody involved in any of this is evil. That's important to say plainly. The banker isn't a villain. The employer isn't necessarily exploitative on purpose. The friend posting the vacation isn't trying to trap anyone. But the aggregate effect of all these separate, individually reasonable incentives is a system that quietly extracts flexibility from exactly the people who most need to protect it. High income doesn't automatically produce freedom. High income produces the raw material freedom is built from. What gets built with that material freedom, or an elaborate, fragile performance of freedom, depends entirely on what happens in the months right after the income rises. There's a version of this that plays out publicly, on a screen, in a way most people scroll past without noticing what it's actually doing. A former colleague posts a kitchen renovation. Another posts a family trip to a resort that costs more per night than most people's rent. A cousin posts a new car, angled just right, captioned casual, as if none of it required a single conscious financial decision. Each post, individually, is harmless. Nobody posting it is trying to manipulate anyone. But the aggregate exposure dozens of these signals a day, every day, for years, quietly recalibrates what normal spending looks like for anyone absorbing them. The baseline creeps upward without a single explicit decision ever being made. Nobody sits down and decides to want a nicer kitchen. The wanting arrives pre-installed, delivered in small doses, disguised as scrolling. There's a version of this comparison that happens in person, not on a screen, and it's arguably more powerful because it comes wrapped in professional credibility instead of an obvious highlight reel. A junior partner overhears two senior colleagues discussing a second home. A new hire at a fast-growing startup notices which car everyone at the leadership level seems to drive. None of it gets said directly. Nobody hands out a memo about expected lifestyle. But the unspoken standard gets absorbed anyway, treated as information about what a person at this level is supposed to look like, rather than what it actually is, one visible data point from someone whose full financial picture nobody in the room can actually see. This matters because workplace peer comparison carries a credibility that social media comparison doesn't quite have. A stranger's vacation photo can be dismissed as curated. A colleague's renovation, discussed casually over coffee by someone whose judgment you already respect professionally, lands differently. It reads as a norm rather than a performance, even when it's exactly as selectively presented as anything online. This is why income alone was never going to fix the problem this video opened with. The baseline moves with the income. Every time. Unless someone deliberately, consciously refuses to let it. That's the fork in the road. Almost nobody is told it exists. There's a version of this trap that looks nothing like a house or a car, and it deserves its own moment because it's becoming one of the most common forms of the pattern. Equity compensation. A software engineer at a large tech company sees a total compensation number that includes base salary, bonus, and stock grants, a headline figure north of $400,000 a year. That number gets used, mentally, as the basis for lifestyle decisions. The mortgage application, the car lease, the private preschool tour. But a large share of that number isn't cash. It's stock that vests over 4 years, priced at a valuation that can move by 40% in either direction based on a single earnings call. When the stock is up, the number feels conservative. When the stock drops, and eventually, for almost every company, it drops, the actual cash compensation left over after the fixed obligations were sized to the inflated total can be startlingly thin. Engineers who lived through a rough stretch in their industry describe an identical sensation. The number that got them approved for the mortgage no longer exists, but the mortgage very much still does. The house didn't get smaller. The stock did. This is paper wealth in its purest form, a number on a compensation letter, treated as permanent, spent against as if it were cash, and vulnerable to a market that owes nobody an explanation for its mood swings. Block 5. The mid-video shift. If you're still here, this is the part that changes the meaning of everything you've heard so far, because up to now, this has sounded like a story about spending discipline. It isn't. Not really. Discipline is a symptom-level fix for a structural problem. The real fork isn't spend less. The real fork is a single decision made at the exact moment income increases, before any new obligation gets built on top of it. Here it is. Every time income rises, there are only 2 directions the increase can travel. It can travel into new fixed obligations, a bigger mortgage, a bigger lease, a bigger recurring cost that locks in for years. Or it can travel into something that isn't locked in savings, investment, optional spending that can be reversed in a single month if needed. That's it. That's the entire fork. Almost every case of high income with no security runs through the first path, almost every time, without the person consciously choosing it. The mortgage broker asks how much house you can afford. not how much house keeps you flexible. The car dealer builds the lease around the new income, not around a margin of safety. Nobody in that chain of decisions is incentivized to ask the flexibility question. So it never gets asked, unless the person asks it themselves. This is the actual, practical version of the zero income test, applied at the moment it matters most. Before signing anything that creates a new recurring obligation, run the number. Not can I afford the payment this month? That question is almost always answered yes, because it's designed to be answered yes. You'll get paid without touching debt. Run the numbers on an actual decision, not a hypothetical one. A household earning $300,000 a year is deciding between two homes. One costs $600,000, with a monthly payment that consumes roughly 28% of gross income. The other costs $900,000, with a payment consuming roughly 42%. The mortgage broker will approve both. The bank sees healthy income either way. The real estate agent will show enthusiasm for whichever one closes. Nobody in that transaction is going to ask the question that actually matters. If this household's income dropped by a third for half a year, a layoff, an illness, a slow stretch in commission-based work, which of these two payments still gets made without touching a credit line or a retirement account early? The $600,000 home almost certainly survives that scenario. The $900,000 home, in a large share of real cases, does not survive it without damage, either debt or a forced sale at a bad time, or a drawdown of savings that were supposed to be untouchable. The bigger house isn't wrong because it's extravagant. It's wrong because it was priced against a best-case future instead of an ordinary one. And ordinary futures, statistically, include interruptions. Almost nobody's income trajectory is a perfectly smooth, uninterrupted line for 30 consecutive years. Job changes happen, industries contract, health happens, markets correct. If the honest answer is no, that obligation isn't an upgrade, it's a bet. A bet that tomorrow looks exactly like today, indefinitely, with no interruptions. Nobody's income guarantees that. Not doctors, not partners, not founders, not anyone. This is where the trap finally becomes visible for what it always was. Not a spending problem, a forecasting problem. A quiet, repeated bet against uncertainty, made every time a raise arrived, disguised as a reward for earning it. There's a cost to this pattern that rarely shows up in any financial conversation because it doesn't look financial at all. It shows up as tension between two people who both, individually, believe they're being reasonable. One partner sees the mortgage statement and feels a low hum of dread they don't fully articulate. The other partner sees the same statement and feels pride-proof of how far the household has come. Neither is lying. They are both responding honestly to the same number, filtered through different relationships to risk, different childhoods, different definitions of what enough ever meant. Money arguments in high-income households rarely sound like money arguments. They sound like arguments about a vacation, a school choice, a renovation timeline, but underneath almost all of them sits the same unspoken question neither partner has said out loud. Are we actually safe? Or are we performing safety for each other and for everyone watching? Couples who never explicitly run a shared version of the zero income test together tend to discover this gap in the worst possible moment during an actual income disruption, when there's no time left to have the conversation calmly. Couples who run it early, even once, tend to discover the gap while it's still cheap to close. That's not a minor side effect of this pattern. For a significant number of high-earning households, unresolved tension over exactly this gap, the difference between performed security and actual security, becomes one of the most corrosive, least discussed pressures in the relationship, quietly outlasting almost every other point of friction couples openly admit to having. Nobody puts misaligned obligation tolerance on a wedding registry, but it sits underneath more arguments than almost any other unspoken variable. Block 6. And here's the part that reframes even the reframe. The people who escape this pattern are almost never the highest earners. They're the ones who built one specific habit before the money got big enough to make that habit painful. They separated two decisions that most people accidentally fuse into one. Decision 1. What does this income allow me to enjoy right now? Decision 2. What fixed structure does this income get locked into for the next 5 to 10 years? High earners who stay financially fragile tend to make both decisions from the same emotional impulse, in the same week, off the same number. The raise arrives, the celebration and the structural commitment happen almost simultaneously. The bigger house search starts the same month as the bonus. High earners who build actual security deliberately separate those two decisions in time. They let the enjoyable spending happen close to when the money arrives. They deliberately delay the structural commitment, the mortgage size, the lease term, the tuition tier, until the new income has proven itself for a stretch of months. Sometimes a full year, sometimes longer. There's a version of this that plays out well, and it's worth seeing clearly because the version that goes wrong gets all the attention. A product manager, early 30s, received a job offer that raised her salary from $140,000 to $220,000 in a single jump. In the first month, she allowed herself one deliberate upgrade. She moved to a slightly nicer apartment, one she could still afford comfortably at her old salary, not her new one. Everything else she left untouched for a full year. Same car, same routine, same modest weekend spending. At the 12-month mark, she had banked nearly $70,000 beyond her existing emergency fund, simply from the gap between what she was earning and what she had allowed her fixed costs to become. Only then did she make a larger structural decision, a home purchase sized deliberately below what she was approved for, not at the ceiling of it. 18 months later, her industry had a rough year. Her company went through 2 rounds of layoffs. She wasn't touched either time, but 3 of her colleagues were, including one who had just closed on a house size to the very top of his approval. She didn't do anything exotic. She didn't discover a secret investment strategy. She did one thing, at one moment, that almost nobody does. She let a full year pass between the raise and the big structural commitment, and she used that year to find out what her actual expenses were before locking anything in. That gap, that deliberate delay, is the single highest leverage financial habit almost nobody teaches. It costs nothing. It requires no special knowledge of investing, no complex tax strategy, no financial advisor. It requires only the willingness to feel, for a while, like you're not fully living up to the number on your paycheck. That feeling is uncomfortable. It's supposed to be. It's the exact discomfort the entire system described earlier is built to eliminate as fast as possible. Because a person who tolerates that discomfort is a person who resists the machinery that profits from urgency. Read that again. Tolerating the discomfort is the whole skill. Everything else, budgeting apps, spreadsheets, financial advisors, is secondary to that one decision, waiting before locking in. Block 7. The hardest payoff, and the one that matters most if you take nothing else from this. Paper wealth and real wealth are not two versions of the same thing. They are structurally different assets that happen to share the same currency. Paper wealth is anything that looks valuable, but requires continued income, continued borrowing, or continued market performance to remain intact. The house is paper wealth if the mortgage requires the current salary to service it. The retirement account is paper wealth, functionally, if accessing it early triggers penalties that make it useless in an actual emergency. The lifestyle is paper wealth if it evaporates the moment the paycheck pauses. Real wealth is anything that survives an interruption. Liquid savings that don't need permission to access. Assets that can be sold or borrowed against quickly without destroying the underlying structure. Obligations sized small enough that a bad 6 months doesn't force a fire sale of the life someone built. The high-income poverty trap isn't about how much money moves through someone's hands in a year. It's about how much of that money ever converts into the second category before the first category consumes it. Paper wealth impresses a room. Real wealth survives a bad quarter without anyone in that room ever finding out one happened. There are 3 signals that show up almost every time before someone realizes they're inside this pattern rather than simply enjoying the rewards of their own success. The first signal: every raise gets a plan for spending before it even arrives. The mental math starts the moment the offer letter shows up. This is what changes. This is what upgrades, and none of that math includes a version where the raise simply sits, untouched, for a year. The second signal: a rough month requires explaining, even to yourself. Not because the number is small, because the story doesn't match the number, and some part of the brain knows it. A person earning $500,000 a year should not need to quietly explain to themselves why a slow month feels dangerous. If that explanation is happening on a regular basis, the structure underneath the income has already outgrown the income's actual stability. The third signal: the phrase "we can afford it" gets used to end a conversation rather than start one. That phrase, said quickly, is almost always covering for a question nobody wants to actually calculate afford it against what timeline, against what interruption, against what version of the future. There's a fourth signal, quieter than the other 3. Checking the account balance has become a small ritual done more than once a day, not to plan anything, just to confirm the number hasn't moved in a way that would require an uncomfortable conversation. That habit rarely gets mentioned to anyone, because it feels embarrassing at an income level where by every external measure, checking that closely shouldn't be necessary. Any one of these signals alone doesn't mean much. All 3, together, showing up in the same season of someone's life, describe the high-income poverty trap with almost diagnostic precision. Here's the objection that always comes up at this point, and it deserves a direct answer rather than a dodge. This isn't an argument for living small. It isn't a case for refusing the nicer house, the better school, the trip that actually matters to a family. Depriving yourself of everything a high income makes possible isn't security either. It's just a quieter, less visible version of the same fear, dressed up as discipline. The argument is narrower than that, and more precise. It's that the size and timing of a structural obligation should be decided by tested income, not projected income. Not can we technically qualify for this, but has this income actually held steady long enough through at least one uncomfortable stretch for us to trust it with a decade-long commitment? That's a completely different filter than the one most lenders, most agents, and most internal impulses apply by default. Somebody can absolutely afford the nicer house, the nicer school, the better car. The actual argument here is about sequencing, proving the income first, locking in the structure second, not permanently denying the reward the income was earned to provide. There's a quieter myth sitting underneath this pattern, one that keeps it running for years past the point where anyone would consciously choose to continue it. The myth sounds like this: things feel secure once the income goes up one more level. Not now, not at this number, but at the next one. That belief is almost never tested against evidence, because the evidence, when it's actually gathered, tends to contradict it directly. The person earning $90,000 believes security arrives at 150. The person at 150 believes it arrives at 250. The person at 250 believes it arrives at 400. Each one, upon reaching the number they named, discovers a new, slightly larger version of the exact same tension waiting for them, because the obligations grew at the same pace as the belief did, arriving right on schedule to consume whatever cushion the new income was supposed to create. Security was never actually a number away. It was a decision away, the decision to let a gap exist between income and obligation, and to defend that gap deliberately at every income level, rather than waiting for a future number to create the gap automatically. It never does. Not once, for almost anyone who hasn't made that decision on purpose. Most people never run that calculation. They see the total number salary, home value, retirement balance added up, and feel wealthy. But wealth isn't a total. It's a structure, and a structure with no slack, no matter how large, collapses exactly the same way a small one does the moment the income that supports it stops arriving on schedule. Consider what actually happens on a household balance sheet that looks impressive from a distance. A net worth statement might show $1.4 million, a home worth $600,000 in equity, a retirement account worth $500,000, a business stake worth another $300,000. Impressive on paper, genuinely impressive. Now ask how much of that $1.4 million could be accessed in cash within 30 days, without penalty, without a forced sale, without touching a structure the household actually depends on for shelter or income. In a large number of real cases, the honest answer is somewhere between $20,000 and $40,000. Everything else is locked behind a mortgage, behind early withdrawal penalties, behind a private valuation nobody can liquidate quickly. That gap between $1.4 million and $40,000 is the entire distance between looking wealthy and being financially secure, and it's a gap almost nobody calculates until a crisis forces the calculation on them. Most people discover it during the worst possible week to be discovering anything for the first time. There's one more layer to this that outlives the person living through it, and it's the layer that should matter most to anyone with children watching. Before that, a quick note on why this pattern is so easy to miss from the inside. Nobody wakes up one morning and decides to build a fragile life on top of a strong income. It happens in dozens of small, separately defensible decisions spread across years, each one made by a competent, intelligent person who genuinely believed they were simply enjoying what they'd earned. That's precisely why it takes an actual written calculation, not a feeling, to reveal what years of reasonable choices quietly built underneath the surface. Kids don't absorb a lecture about money. They absorb a texture. They notice conversations that happen behind a closed door. They notice the tone shift when a mail envelope with a certain logo arrives. They notice which purchases get announced happily and which ones get made quietly, almost apologetically. A child raised inside the high-income poverty trap often learns two contradictory lessons at once, without either parent intending to teach either one. Lesson 1: we have plenty. Look at everything we have. Lesson 2: something about money is fragile, urgent, and not to be discussed directly. Those two lessons don't resolve into confidence. They resolve into a specific kind of anxious relationship with money that frequently reappears, almost identically, once that child becomes an adult earning their own high income, because the pattern was never explained, only inherited. There's a practical version of all of this worth naming clearly, because abstract awareness rarely changes behavior on its own. Once a year, ideally right after any raise, bonus, or major income change, sit down and actually write out every fixed monthly obligation, not estimate it from memory. Write it, line by line, mortgage or rent, every lease, every tuition payment, every membership, every recurring subscription, every minimum debt payment. Add it up. Compare that total against take-home income, not gross income, not the headline number from the offer letter. Then ask the single question that this entire pattern depends on nobody asking: if this income dropped by a third, starting next month, for 6 months, which of these obligations survive without borrowing, without selling something, without a difficult conversation with a partner or a bank? Whatever doesn't survive that question isn't automatically wrong, but it's no longer invisible. It's named, and a named risk is a risk that can actually be managed, negotiated down, renegotiated, or deliberately accepted with open eyes instead of quietly absorbed as background anxiety that gets soothed with another purchase instead of addressed directly. A family earning $430,000 a year combined finally ran this exact calculation after a scare, not a layoff. Just a 2-month gap between contracts for one spouse that revealed, uncomfortably, how little runway they actually had. They wrote down every fixed obligation: mortgage, 2 car payments, a private school tuition, a country club due, 3 subscription services nobody remembered signing up for. The total came to just under 71% of their combined take-home pay. 71% on $430,000 a year. Numbers most people would assume made that family untouchable. They didn't sell the house. They didn't pull their kids out of school mid-year. What they did was smaller and slower and considerably less dramatic than either of those options, and also considerably more effective. They refinanced one car instead of leasing a replacement when the lease ended, dropping one fixed payment by $400 a month. They canceled the club membership neither of them had used more than 4 times that year. They renegotiated the tuition payment schedule to align with their actual pay cycle instead of an arbitrary due date that had been quietly causing a cash crunch twice a year. None of it felt like sacrifice. Most of it felt, honestly, like cleaning something that had been cluttered for years without either of them noticing. 18 months later, that same 71% had dropped to 52%. Not because their income changed, because they finally looked directly at the number instead of managing around it in the dark, one anxious month at a time. That's the entire outcome available to almost anyone willing to run this calculation honestly, at any income level. Not a lifestyle downgrade, a structure upgrade, the exact same life, built on a foundation that can actually take a hit without the whole thing needing to be rebuilt from scratch. This is how the trap outlives any single household. Not through a lesson taught on purpose, but through attention absorbed by osmosis, then reenacted a generation later under a different roof with a different salary, and the exact same invisible architecture underneath it. This applies differently depending on where someone actually sits on the income ladder, and it's worth being specific rather than vague about it. For someone in the $75,000 to $150,000 range, the trap usually shows up through a single oversized obligation, one lease, one home, one recurring cost that consumes an outsized share of the paycheck and leaves almost nothing for the unexpected. The fix there is often mechanical. Identify the one obligation doing the damage and refuse to renew or upgrade it at the same size next time. For someone in the $200,000 to $500,000 range, the trap usually shows up through accumulation 5 or 6 individually reasonable obligations stacked together, none of which look dangerous alone, all of which look dangerous together. The fix there requires actually adding up every fixed monthly cost in one sitting, something most people in this range have genuinely never done, because the paycheck has always been large enough to avoid ever needing to. For someone above $500,000, the trap usually shows up through paper wealth substituting for liquidity equity, real estate, business ownership stakes that look enormous on a net worth statement and mean almost nothing during an actual 30-day cash crunch. The fix there is deliberately converting a portion of that paper wealth into something boring, liquid, and immediately accessible, even when every incentive in the surrounding financial industry pushes toward reinvesting it into something bigger instead. Different income. Same underlying question asked at a different scale: how much of this could survive an interruption? Right now, without borrowing, without selling, without explaining anything to anyone. The number changes. The math scaling that number against actual obligations never does. Whether the income is $90,000 or $900,000, the same test, applied honestly, produces the same kind of answer and the same kind of relief once it's finally been run. That's the whole trap, stated plainly, one final time. Income convinced them they'd arrived. Obligation convinced the bank they were a safe bet. And nobody, at any point in that chain, was required to ask whether the person underneath it all could survive 6 quiet, uneventful months without their paycheck. Go back to where this started: $600,000 a year and a rent payment she couldn't cover on her own without asking for help. At the time, that sentence sounded like a contradiction, almost impossible to reconcile. It isn't a contradiction anymore. Not after everything in between. She wasn't careless. She wasn't foolish. She was running the exact same program as the surgeon who borrowed for a property tax bill, the creative director who sold a watch to make a car payment, the attorney whose savings shrank the year her salary grew the most, the agency owner whose 7-figure year left him thinner on cash than his lean years did, the engineer whose compensation letter promised a number the market quietly took back, the commercial agent whose best year became her most fragile one. Different industries, different numbers. The same invisible architecture built one reasonable decision at a time, underneath every single one of them. None of them were bad with money. All of them mistook a rising number for a stable one, and built accordingly. Here's the one line worth remembering after everything else in this video fades. Income tells you what you earned. Only your fixed obligations tell you what you actually own of it. Read that again if you need to. It's the difference between the version of wealth that gets photographed and the version that survives a bad year. There's a question this naturally leads into, one most people never think to ask until they're already living the answer. If income isn't the actual measure of security, what is and how early in a career can someone start building the version that survives instead of the version that just performs? That's a different video, and it starts exactly where this one ends. Not with how much you earn, but with how much of it you were ever allowed to keep before something else quietly claimed it first. Because here's the part nobody puts on the paycheck stub. The part no offer letter mentions. The part that never shows up in the number everyone else sees and quietly envies. A high income doesn't ask permission before it becomes a high-income poverty trap. It only asks one question, over and over, every time it grows. What are you going to build on top of me, something that survives without me, or something that quietly needs me to never stop? Most people never hear that question asked out loud. Now you have. The number was never the proof. It was only ever the invitation. What gets built on top of it, that's the part that decides whether the ending of this story looks like hers or looks like something that finally holds.